Thanks for joining us. My name is Dan Grube. I'm the Regional Relationship Manager for FarmOp Capital. We do agricultural lending, primarily focusing on operating loans. We all know the reality of farming right now. We're starting down a potential fourth year of tightening margins. And as you'll see in a moment, we are seeing some really unusual net worth losses across the board. While the ag market and the industry as a whole has always had its ups and downs, the sheer length and depth of this specific cycle is a significant deal as we look forward into 2026. The core theme today is that when margins are like this and tight, borrowing can not just be a simple line of credit to bridge a gap. In this environment, every dollar borrowed must be a strategic investment, and we want to help you identify the best calculated bets and new growth opportunities despite these headwinds. Our goal for the conversation is to help you shift gears from just reacting to the market pressures, what I will call survival mode, to a proactive strategic growth mode, making the transition require a fresh look at how you use capital to reach your long-term goals on the farm. I'm very excited to introduce Dr. Gary Schnitkey with us. He's a professor of farm management at the University of Illinois and a leading voice in ag strategy. Gary's knowledge and use of data from the FBFM provide the kind of real-world insights and help us understand exactly where grain farming profitability stands today.
Thanks, Dan, for having me here today. Excuse me. You know, I can take you through a little bit about where we see the agricultural economy at right now, and 2026 looks a lot like 2025, which, as you mentioned, wasn't a very good year. Overall, from a price standpoint, we're sort of in the 425 projection range for 2026, and if we look back, the last 3 years were if we use USDA prices, we're at 455 for corn, 424 in 2024, and 410 in 2025, and now another year of 410 to 420 for 2026 is what we're looking at right now. And those are going to be, again, pretty tight, result in some pretty tight margins. And that comes off of that year from 2021 to 2020 and 21 and 2022 when we had higher prices. And those higher prices, we hit a high of 654 and from a market year average standpoint, and those were higher income years and higher return years then, and again, we've returned back to lower prices, and lower prices then result in those lower returns. However, what makes this time different, or maybe not so different, is that we also had cost increases. And between 2020 and 2023, we saw costs go up considerably. In Illinois, we hit a high of over $1,000 per acre in terms of cost, and that included some non-land cost of $697 per acre. And then we estimated the cash rent, or average cash rent the year for Central Illinois high productivity land, to be $359, giving us at $1,000. We've seen that back off a little bit. And we're actually projecting for 2027 a $974 total cost for cash rent farmland on 50/50 crop share land. But that 974 is much higher than it was between 2015 and 2020. And that period was one where we saw a bit of returns, but not much. So now we've had prices come down, but costs stay high. And on many farms, that's causing negative returns, and that's likely to continue in 2026. What's helping back that off a little bit are federal ad hoc payments, and that included the ECAP payments for 2024 and the Farmer Bridge Assistant payments, which farmers are receiving here in March for the 2025 crop. So those are helping with the cash flow situation, but we're still looking at clearly negative returns for 2026 if we don't again get those Farmer Bridge assistance payments or something similar to that. As a result of that, we did see net worth on our average FBFM farms go down in 2024. We're compiling that data for 2025. We'll see where it goes, but for the first time in a long, long while, we saw net incomes or net worth decline on average across farms and grain farms in Illinois in 2024. And again, we're summarizing the data for 2025 right now, but I would expect those incomes to remain low and net worth to just be hanging in there. So that puts a premium on conserving cash flow right now and making sure that we have things in order. So profitability is tough right now, and so that's where we're at and likely to be here for a while.
Okay. Gary, while the egg market always has its ups and downs, data from Illinois farm business, farm management shows a level of net worth loss. So you mentioned that among grain farmers, that's really unusual. We're seeing a persistent cycle where costs haven't come down. I know you mentioned a little bit on some things and some of the strategic things with the government, but it hasn't matched the lower prices. And where we are now, starting down a fourth year ish, why is this extended in duration of this specific dip hitting the balance sheet so much harder than typical cycles the farmers are?
Yeah, yeah, that's a really good question. And you know what probably makes this time different is that we saw those costs go up so much more than than in recent history. And you go back to that 2020 to 2022 period, we saw inflation come back, and then we had COVID, and all those things increased our cost, and power cost and machinery costs went up. It's sort of interesting. The cost of new machinery went up about 30% during that period. So that was quite substantial. None of those costs have come down. So it has put us in a real price cost squeeze. And that price cost squeeze now is worse than it was in 2015 when the last time this sort of happened. We sort of saw another price cost squeeze back in the 2014-2015 period. The cost hadn't gone up as much as they had this time. So we're sitting here now with lower prices and higher cost. And again, for the first time, we saw net worth decline on grain farms overall. But the ones that are probably getting hit the worst are those that have significantly more of their land rented, particularly with cash rents, because those cash rents have also been sticky and they haven't come down. So we're sort of sitting here waiting for something to come down, and nothing is coming down.
So I want to kind of ask a little bit of an interesting question here. We talk about, I hear a lot of people mention, is this in 80s? Is this like the 80s again? And I think I've seen enough and heard enough that you're saying that this isn't a comparison to the 80s because of that debt leverage is low, because because debt leverage is lower, but profitability is harder to find. Is it fair to say we've moved from a crisis of debt to a crisis of margin?
Yeah, no, that's exactly the situation. And if you go back to the 1980s, we had significantly more debt in the agricultural sector. the 70s sort of set that up where we had many farms expand using debt capital, buying some land, and we saw debt levels go up. Remember, back in the 1980s, we had the inflation pressures, and we saw the Fed come in and try and get control of inflation, and the way they did that was by raising interest rates. We had interest rates in well above levels that are today, much higher debt levels. And then to top it all off, in the mid 1980s, we saw farmland prices decline. So all those things combined to cause some farmers to become insolvent. We aren't seeing that today. Farmland prices are holding in there. They're not going up anymore, but they're just holding in there. No one is really expecting those prices to come back down. So those prices are holding in there. And overall, we see very low debt levels on many farms, and there are exceptions. There obviously are exceptions, but the solvency position is pretty good in agriculture, and the liquidity position coming into this period was very good. Farmers had a large amounts of working capital, and that was coming off 20, 21, and 22. And so they came in strong financially from a solvency and liquidity standpoint, but the profitability simply isn't there. So we're seeing many farms using their working capital to make it through. And we're beginning to see solvency tick up a little bit on average. And again, obviously, there are some farms that have much higher debt levels and much worse working capital position on the average. But overall, most farms are in reasonably good position. They do have a profitability issue, a margin issue.
So reading in a little bit, since the challenge today is clearly about managing the tight margins rather than just managing debt, because you talk about solvency and so on and so forth, it really forces a shift in how a farmer evaluates success on their own acres. And
Yep.
I was wondering, when it comes to survival strategy, your advice on maximizing profits over yields.
Yeah.
I feel like this is a very important component moving forward in 2026. I feel it's been a trend for a very long time to focus on yield. Can you give us a real world example where
Yeah.
farmers might, you know, do
No,
that?
it's very easy for farmers to develop strategies to maximize yield. I mean, everybody comes to a farm and has a product that will increase the yield a bit and increase the ROI there. Well, those are all good until and they work better when you have $6 corn than when you have $4 corn. So right now we're in a position where some of the strategies that worked when we had better prices don't work so well anymore. And we really should, and I maximize returns and not yields. And a prime example of that is with nitrogen fertilizer. We see many farms apply above university recommended rates. And those university recommended rates are designed to maximize profits. And they're sort of in Illinois in the 170 to 180 pounds of actual end range for corn. We see many farms above that. Um, Now those higher rates may increase yield a bit, and that the key word there is a bit. But the extra bushels from those do not cover the extra cost of the nitrogen. So there's that decision. P and K sort of are in the same way. And then you really need to, again, begin looking at all of those pesticides that we've added over time and, the fungicides, the herbicides, the seed treatments, and seeing if we can't back off of those a bit and maximize our returns. Maybe not totally our yields, but maximize our returns.
Yeah, and as a lender, it seems clear that maximizing profit requires some tough operational shifts right now, and I'm going to tie that back to 2023 crop cycle into the 2024 year when we saw the major decrease. And I feel like going forward, those changes often lead to difficult conversations with lenders. And as a lender, I'm curious, as that working capital begins to decrease or erode, what's your thoughts? Can what your thoughts around some of that conversation might look like?
Yeah, so and lenders are going to have their lending limits. Just
Right.
let's just put it that way. And so, with that lending limit in place, and those are going to become more and more constricting as we move through time. The working capital is going to kind of be coming off the balance sheet. So, how are we going to deal with that? And first off, is make every input decision really evaluated, and maybe try and cut significant portions from our income input budgets. I would also say we're going to have to begin delaying machinery decisions as we're moving forward. We saw machinery purchases really be at high levels from 2020 to 2022. We're not seeing the income now, so those purchasing decisions have 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 declined. Um, but we still need to maybe even see those come down more. And, looking at some of the higher priced items when we have to replace them, like combines, is there any way we can, combine operations with a farm in a similar shape place and really operate those combines at an efficient level? So all of those things, kind of play together, working on conserving that capital and working within those operating limits.
Yeah, and I might be you might have answered some of this question, but I would kind of want to re-ask it again and kind of try and tie it back to when we were talking about the erosion of working capital and some of that stuff. As a banker or lender, my brain's going, you didn't mention it directly, but basically traditional operating notes are kind of running out and there's more need for operating loan. How does that persistent negative return environment change that conversation between a farmer and their bank? And you kind of addressed that, I think, just now with equipment and efficiencies, but I'm just curious if you had any other thoughts around that.
Yeah, yeah. So, somehow, some way, we have to turn. I mean, we can only have negative returns so long before things have to be turned around. So, if we're in a tight margin, we have to really, particularly as we get lower and lower on the working capital, and we're eroding that away, we really do have to look at ways of cutting those costs so that we can live within those budgets. And we mentioned some of those. And again, a lender is going to be sitting there going, this is how if we make this loan, or is this borrower going to pay it back?
Correct.
And coming up with every expenditure being necessary for for reaching that goal of maximizing returns is a good way to think through that.
Yeah, my next question is probably something I'm curious what you have found talking with farmers because you spend a lot of time with that. For a farmer who's built their net worth over decades, only to see it erode over the last 4 years straight, what's that emotional toll? What are you kind of hearing when they go in and talk to their bank? What's
Yeah,
that kind of
yeah,
feel like? Just an opinion.
yeah. No, it's a tough sort of thing, right? and again, you know, in this environment, I would first say, let's make sure we're monitoring these things pretty well. Let's get our financial statements in order, and let's try and have those have as much emotion taken out of these decisions and having it based on the facts on the ground as far as that operation. And that generally starts with a good set of financial statements.
I would agree.
And once we have those good set of financial statements, we can begin and say, all right, A to B, here's where we're at now. We want to get to B. Let's develop a plan to get to B. And B is, some, and that will have to include some sort of cash flow
Yeah.
projection.
Yeah.
And so when we get to that point and we can develop a reasonable plan that gets us to A to B,
Yeah, I would agree that the more information, lenders are usually happier with the more detail and the more information. I completely agree. And just a little bit about us, a little bit of FarmOp in this conversation. One of the things that we do at FarmOp with our model, we can support those farmers with lack of high equity in their own land by focusing on their production and their records that they've already proven in future potential rather than just a current balance sheet. We look at the farm's production reality. If the yields and historical performances are there, that is where we find the value, not just in the real estate, by using crop insurance as a primary pillar of our loan and our loan structure and size. There is a backdrop of that loan. We create a floor that provides the kind of breathing room or more complete budget that traditional banks might have trouble with or might take away when they see liquidity is light. Our goal is to move that conversation from how much do you own, what's your equity position on your real estate, to how much can you efficiently produce, which shifts the focus back a little bit to that farmer's skill and production. We provide increased loan sizes as part of our strategy to complete that budget to make sure that we're getting all the costs covered. Farmers are, instead of just surviving, but we're capitalized well enough to get the farmer capitalized well enough to complete their crop cycle to get through that year. I just mentioned that because of the conversation we're having. When you shift the focus towards that production skill set, the quality of the data becomes your best leverage, kind of like information on financials, which is why our advice on scenario-based planning is so timely for farmers looking at 2026 operations and options. You've advised farmers, I believe, to look through various cash flow scenarios to their operations. Why is a detailed scenario-based projection a survival necessity now compared to the high margin years in the past? What's your thoughts on that?
Yeah, no, in tight margins, it's absolutely more critical to look at those cash flows again to get some realism there. And I take that down, let's do a cash flow on for corn and soybeans, and most farmers have a pretty good idea of their production plan or what they're going to do, and then cost that out. All right. And when we begin costing that out, we can come up with a projection of our cash flow. We all of a sudden then know what sort of revenue we have to cover that. So that also aids in setting objectives for marketing. So that detailed cash flow will aid in understanding what we need to accomplish, and it will also allow us to monitor how well we're doing it during the year by comparing to where we're at relative to the cash flow. Again, that requires some granularity. I mean, we can take this down. We pretty much do know at this point in time what inputs we're going to be placing on, and that helps in knowing our cash flow and when we will have our operating needs, when it will be the highest, and all those sorts of things.
So, Gary, in your experience, does a farmer's marketing, their skills and savvy at that, and ability to spread sales and manage price risk actually get the credit it deserves, or do you think it's going to be a very much more purposeful thing when it comes to securing a loan and moving forward based on what you're thinking about those budgets? Yes.
Yeah, yeah. Having having some sort of marketing plan is a good thing, and that marketing plan, it's good to have as part of that spreading sales, so that we spread the risk out, and that that will aid coming up with our cash flow, but it also aids us in knowing that spreading sales obviously reduces risk, and also spreads that out. I would also say that, traditionally lenders are hunting for red flags there, and looking for things when where we're looking at negative margins, particularly on cash rented farmland.
Yeah. Yeah, I'd agree. And as I mentioned before, our model, FarmOp, supports farmers who lack that equity and that own land by focusing on, and I talked about the crop insurance being a part of the pillar of that. We also do tie back to marketing and give value to that in our model, which I think helps and I think is, going to play into the future over the next several years. But once we move, past that immediate hurdle of securing the right capital, the conversation naturally shifts to what that capital can build for you now and into the future. So if a farmer is looking toward the end of the year into 2027, what specific thoughts, questions should they be thinking, asking their financial partners right now to make sure they are, equipped to not only stay viable, maybe even yet
Yeah.
grow and scale?
Yeah, so in this environment, we're also often looking for alternatives. So, and diversification that diversification can take the form of livestock, for example, and maybe that is one of the things. There's also, we see many farms having other farm businesses, or other businesses that are part of their operation. Is their lender willing to work with them as they look at those operations as part of the farm, and thinking about diversification, and taking some of the burden away from the farming operation to generate the whole cash flow? I guess I would also mention, off farm, just that off farm businesses, and how the lender views those things, and how willing they are to be a partner in those operations.
Yeah, and that's something I think, we believe in farm op world, that larger loan size and that specialized structures help farmers. So I'm kind of following along with what you're suggesting. As farmers pursue future goals, even if it's a tight economy, we're wanting to provide enough capital necessary to pivot into non-commodity or organic shifts because we value the plan of what their potential return, not just current land equity. I've mentioned that a couple times. While traditional lenders might see a major operation shift and added risk, and we see it as a strategic move toward profitability, as you're mentioning, in structuring our loans to support that growth. The model we have, FarmOp, is designed to be a bridge to the future for the farm and overlap from year to year, ensuring that a multi-year margin squeeze doesn't prevent a farmer from being able to make the investments needed to stay competitive. It's clear that while the egg economy landscape is challenging, sounds a little bit like we've seen these cycles before, and this one may be different and lead us, to a different solution. But I think that there's a path forward. I'd like to take a moment, kind of, make sure I got everything and recap our conversation and some of the key strategies we've discussed and how we can help the farmer. I think prioritizing profit over yield with grain farm net worth declining at record rates. Success now depends on aggressive cost management, such as sharing machinery, you mentioned, refining inputs rather than chasing high yields that may not cover their own cost. Strategic borrowing to move past survival mode, use detailed cash flow scenarios to prove your operations viability to lenders, especially when pivoting towards higher margin specialty crops. Um, and diversification. We talked about that, all farm things. We want to talk about that. By farm, we want to build this for the specific economy, valuing that you grow not just what you own, by valuing the entire operational ecosystem, if you will. FarmOp Capital moves beyond old rigid collateral models. This allows us to actually reward the management skills and the production history rather than just a balance sheet. Our loans are structured around their proven yields and the reality of your specific acres. That often allows us to provide the capital you need in places where a traditional real estate lender might not. We treat your crop insurance and your strategic marketing plans as fundamental security for our loan, and I think that's very important. But we believe that a strong risk management plan is just as valuable as the land equity. Gary, I can't thank you enough for your input and what you were talking through today. It really helps us. I think it helps us as lenders. Um, uh, I think the insight's incredible. I think that helps get a path forward. I think for everyone listening, our goal, your goal, FarmOp's goal is to help, turn these strategies into reality for your farm. I encourage you to reach out to any of us at FarmOp. If they've got questions, reach out to you, Gary. Do you have any closing thoughts, Gary?
No, I was just going to say we're getting close to spring here, and so we're going to be putting out that crop again. But let's really emphasize maximizing returns and not yields this year.
I like it. Thank you, sir.
You're welcome. Thank you for having me.
Appreciate it.